We are live on YouTube.
Okay. Good evening, everyone. This is Dr. Aishwarya Krishna from Center for Capital Markets and Risk Management at IIM Bangalore. I take this opportunity to welcome all of you to the Global Money Week 2021 being held by IIM Bangalore in collaboration with SEBI and NSE IPFT. So this entire program is held on behalf of Platform for Investor Education, which was a joint collaboration between IIMB and NSE IPFT. Now, we have been conducting Global Money Week webinars for the past 2 days. And today we have with us Professor Hemant Manoj. He teaches specialized courses in finance and investments, derivatives, and risk management. He is from SPJIMR. He has worked in the areas of securities regulation, fund management, equities research, risk management, loan portfolio management, and stressed assets. Well, he is a fellow in management, finance and control from Indian Institute of Management, Calcutta. And he is also a certified FRM, financial risk manager from GART. Well, of course, his areas of interest are teaching and research and consulting. Well, thank you so much, Hemant Manoj, Professor, for agreeing to us to be a part of this Global Money Week. So I welcome you once again, and the floor is all yours. Thank you.
Thank you, Dr. Krishna, for giving the introduction. And I am happy to be here talking to a wide set of people on one of the areas which I have worked for a long time, and I've been now researching for some time as an academic as well. So this is close to both my heart and my mind, so to say. So let us, without much ado, I think, let me try to present the screen by sharing the screen. 1 second. Yeah. Right. So I hope the screen is visible now. Right. So today I want to talk for a while about something very simple and basic in our life. It is one of the needs of our life, actually, is how to invest properly. Once you have got earnings, once you have got savings, then how do you invest properly? So that is something we will talk as a part of our series in the Global Money Week. And let me begin with telling what I will be doing in the next next 40 odd minutes. I will be touching briefly about what is the objective of investing. When you invest, what should be the objective of investing? What is the investment process that one should follow? And finally, what are some of the good practices that one can follow? These are all, if I may add, these are all, as I said, based on my long my long experience, including some success, lots of failures of my own, as well as success of many other successful investors and researchers across the world. So, what is our investment objective? If I can ask, suppose you have two investment options, A and B. And here, A is this y-axis A. This denotes the returns on the investment, and the x-axis is the risk of the investment. So A has higher return and lower risk, B has lower return and higher investment. So which one will you invest in? Fairly simple question. I guess everyone will like to invest in A. So why I put this chart up is to say that this is actually the crux of sound investments. This is actually the key of sound investment framework. As long as we keep track of the returns and the risks on investments, we understand these, we should be able to invest wisely and properly. So, well, the picture basically says that a plant grows over a period of time. Not all the plants grow to your desired levels, but you put the right seeds, the right manure, the right level of water, warmth, and hopefully it grows to a mature plant. Likewise, investments also follow a similar pattern. As we saw, the investment objective should be not just to maximize returns. That was the idea of the previous slide. The idea of the previous slide was to tell you that there are two dimensions of investment, both returns and risk. And we must maximize the expected returns per unit of risk. That is an important part of investment philosophy. You should always keep one eye on the risk. Well, it sounds fairly simple, right? Who would not think in her right mind that you should maximize the returns per unit of risk? What is so big deal about it? Right? Very simple, very logical. Yet, most investors find this difficult to achieve in real life. That is also a fact. So, what happens? Where is the problem? Where do the investors why are the investors not able to achieve the highest level of expected returns per unit of risk? That is what we will actually deal with in the following section. Now that we know what is our investment objective, how do we achieve that objective? Let us see that in some simple ways. So what is the right investment process? What is the right path that one should follow? If you drive on a highway, if you drive on a road, you are told that the faster vehicle should be on the right side, the slower one should be on the left side, and lots of other things you should take care of while driving. Likewise, there are things that you should take care of while investing. And what are those things? And what is the right investment process? That is what something we'd like to look at. I would like to introduce you to something called the 4 pillars of successful investing. There are 4 pillars of successful investing. Before you invest, you need to take care of certain things. Before you invest, you need to plan for a good asset allocation. Before you invest, if you have got 100,000 rupees, how do you allocate that 100,000 rupees between the various assets? That is the top-down approach. That is the first thing you should think of. And for that, there are basically 2 sections within that. One is assess your own risk appetite. Risk appetite means you see in real life also on the roads, some people driving very fast and some people driving slower. On the same road, it might be a bumpy road, A typical Mumbai road, a lot of the monsoon times roads, it might happen, or it might be a highway. It might be a Mumbai-Pune expressway, smooth as ever. So, but some people drive fast, some people drive slow. As long as the fast driving person understands her own driving abilities, her own controlling abilities, and she's in control of it, it's perfectly fine. If she or he is not able to control it well, she or he is better advised to drive slower. Likewise, in investment also, you have fast lanes, you have slow lanes. I mean, to quickly jump to uh, the example, a broad, very high level broad example, a slow lane is typically, let us say, a scheduled bank fixed deposit. It will keep growing at 6%, 7% per annum. A fast lane could be your stocks. So there are, in two broad terms, you have, so once you know whether you prefer, first thing you have to decide whether you want to go in the slow lane, you want to go in the fast lane. Because these are two different things, which is what we'll see in a bit more detail very shortly. But you understand the difference. You have something called risky assets, risky securities, risky investments, and safe investments. So you have to first thing know how much of risk you are willing to take, and between risky and risk-less investments, how much you want to divide. That is a very important part, the first important part of your investing journey. That is something, in fact, you cannot change on a daily basis. When the markets are up today, so suddenly I become very risky. I start taking a lot of risk. That's a wrong approach. You should decide it upfront, and right. So asset allocation is something very important. Unfortunately, as I said earlier, it might sound rational, it might sound simple, but a lot of us forget to do it. Actually, we don't do it consciously. So this is the first step. The second step is, once you know that, then you construct your portfolio. And for constructing your portfolio, let us say you have chosen, you want to be in risky assets 60% of your portfolio. Now, what all should be in your portfolio? Should you invest in stocks? Should you invest in mid cap, small cap, large cap? Should you invest in bonds? Or, these are, and then there are various other investment opportunities. So for that, one good thing is you should diversify across various assets. That reduces your relative risk, right? That reduces your risk relative to the return. So you should diversify your portfolio and then construct a good portfolio. That is again a process that you should follow. Once you have invested, so you have got your assets allocated between risky and risk-free assets, you have developed a portfolio, you have chosen certain stocks, you have built a portfolio. What do you do after that? Do monitor your portfolio regularly, review them on a regular basis, right? Depending on the type of portfolio you should review, you can review it annual basis, quarterly basis. Some people even review on daily basis if it is so volatile and if that is the kind of portfolio you are, but do review your portfolio. And then finally, be disciplined to stay on your path. As I said earlier, just because the markets have gone up today by 3%, it should not make you bullish. So stay on your pre-thought path and follow the discipline of reviewing and adjusting on a rational basis, not on emotional basis. That is the first point. Second point is, this is the this is the mundane part of it, so to say. You have your demat accounts, you have your corporate actions like dividends, you have your tax matters. So do keep track and do maintain proper records of these. These are as much important as picking up the stocks. So a lot of us again are not good. So do take help of third-party support if required, but it is ultimately your responsibility. So this is the fourth pillar. So these are the four pillars that run you through your investment life process, and do follow this. I just mentioned about asset allocation. If I have to rank among all of this, asset allocation is the most important decision in investing. Yet it's not always done. So this is basically about how much of risk I'm taking, how much of risky assets is appropriate for me. And of course, this requires ability to understand your own risk-taking capacity. It may sound philosophical, but you have to ask yourself, what am I? What are my constituents? My brain, my heart, so to say, which drive me towards the risk-taking. Right? And it goes, you can draw your conclusions based on your own observing yourself. There are some good measurement methods also, but simple task as, do you take risk while driving? Do you take risk while crossing the road? Do you take risk while making this, regular your everyday decisions? That should feed into understanding yourself. So do understand yourself. That is very important. And of course, understand yourself and then match it with the risks in the assets. These are some of just an example of some of the assets. You have investment assets, you have government bonds, PPF, post office savings, which are at the top. Then you have corporate bonds, bank FDs. Then you have lower rated FDs, which means A-rated FDs, and then bonds. And then finally you have stocks. So if while talking of investment, stocks is the first thing that comes to your mind, please bear it in mind. They are the riskiest asset class of those listed over here. Please consciously remember that. And when you develop your portfolio, keep in mind that factor. That is important. So why that is important? Stocks are very attractive because everyone thinks you can double your money in 3 years, 4 years time. If not faster. Many of us dream of and aspire to do it much faster. It comes with accompanied higher risk compared to other asset classes also. It is a good asset class provided you understand the risk and know you are ready to take it. Okay. So willingness to methodically assess risk and implement the required follow-up actions. So consciously doing that is very important for asset allocation. Right. Next point I would like to highlight is, why are investors poor in assessing the risk? What happens when we say that investors assess the returns easily but not the risk? Why is it so? Because it is not easy to assess. As simple as that. Best performing stock of last year may perform poorly next year. You don't believe me? These are 3 illustrative examples of just 3 stocks in the Nifty and the Sensex. These are 3 illustrative stocks, right? See how they have performed in the last 15 odd years. There have been stocks which have done wonderful in the previous year, and then they have given sharply negative returns in the next year. I'm not talking of these low rated stocks. These are by common belief among the best performing stocks. Even the data shows over the last 15 years, these have been the top performing stocks. But you see how the stocks vary. So there is no guarantee if you invest in one of these stocks, every year you will keep making 15%, 20% per annum. Right? This is what data I want to show you. This is second chart basically says that if you start at 100 rupees at any point 0, let us say over the next 100 days or 100 weeks or 100 months, whatever, 100 months, there are various possibilities of returns that you might get. That 100 rupees might go up to 500 rupees. It might fall up to 60 rupees also, 40 rupees also, 30 rupees also, right? It can move in both ways. That is what is called risk. Risk means the potential to suffer losses on account of adverse movements in the prices of your investments, and it can happen. So keep it consciously in your mind. While assessing risk, it is not easy. Another reason is that because it is considered to be mathematical, it involves at a very basic level, it involves just some basic maths, but as you want to be more and more accurate, it involves some complex maths also. On the other hand, risk assessment makes you feel a little uncomfortable. So in a bullish market, it's not easy to think that, what if I lose a lot of my money? So it puts stress on your brain. That is a psychological thing. So investors are reluctant to think of risk as much as they think of returns. Although the fact is the raw materials that you need to assess the risk and the return, they are the same raw materials. They are the projections of the future returns, projections of the future prices. That is what is required to assess both. However, investors find it difficult to assess risk. So suppose you are let me read out something. Suppose you are an investor, you are an entrepreneur actually, where you are likely to generate a return on investment of say 14% per annum. This is an average decent entrepreneur's business. It's not too high, not too low. An entrepreneur should genuinely expect that kind of a return. So it looks a decent business. You are that entrepreneur and suddenly bad luck strikes you, and in one day, suppose you lose 1/3 of your full year returns. In one day, you lose 1/3 of your full year returns in one day. Right? How bad would you feel? Right? Terrible. And what now if I tell you that in your business, you will keep seeing this frequently? Lot of us will develop cold feet getting into this business. It is not a very beautiful scene. Now let me tell you, if you have been an investor in the Indian stock market in the period over the last 18 years, you would have lost more than 5% on one day. More than 5% on one day, on at least 28 occasions in the last 18 years. But it is also true that if you stayed invested in the Sensex or Nifty through the last 18 years, you would have generated a return of 14% per annum compounded. So you are back to the original business you are talking of, suffering severe losses on certain days. But if you stick to it, if you stay through the course, you do make a good return. There are lots of learnings in this. We will not go into everything. What we are just saying that investing in stocks does give good returns over long term, but it can give you goosebumps in the short term. That is what is the risk. That is what is volatility. So both are true, not just any one side. Does tenor of investment matter? Someone says, I want to invest for 6 months. Someone says, I want to invest for 6 years. How does it matter? This is a graph, again, some data. I will be keeping on illustrating data to you to tell you I am not talking empty philosophy. I am showing you data. This data says that if you had invested in a 5-year, for a period of 5 years, there are 3 investors. One had invested in a period of 5 years, one for 10 years, one for 20 years. The tenor of investment differed, right? For the blue one, the 5-year investor, the returns moved like this along the blue line. That is how the returns moved. For the 10-year investor, this is how the returns moved. And for the 20-year investor, this is how the returns moved. This is, mind you, this covers the entire period. Since March, since this is of, so our, one of our indices, the BSE Sensex, that started in 1979. So if you take since 1979, take the period since 1979, right, which is about 41 years back, over the period, this is how returns would have behaved for investors with 3 different tenors of investment. What it means is that, what is the lesson from this? You see the ups and downs of the blue one and see the ups and downs of the green one. It is more steady. The green one is more steady, right? It is also on the whole not lower. On an average, both are the same because both are for the same period, same index, but the period of investment is different. Market prices move randomly in the short term. So in the short term, it is difficult to predict where my next day, next week, next month investment will go, where the prices will go. But longer term, just like we saw in the previous slide, longer term, if you stick to it, you can ride out the bumpiness. You can ride out the volatility. You can ride out the risk. If you stay on your investments for longer term, it helps improve your risk-adjusted return, which is what is your objective. Don't time the market. Spend longer time in the market. Because stock prices are random. So if you try catching a stock at the top or the bottom, most of us will be unsuccessful in timing it. So it's a mug's game. We should not try that. So invest at whichever points, stay long enough, and your volatility will be evened out. And this is, of course, Albert Einstein who had said, compound interest is the 8th wonder of the world, which means over a long period of time, compounding comes into picture and you make a lot of money. Right. So to the final part of my presentation, which is basically talking of, so this was a good framework. What we talked of is a good framework. We said you should have asset allocation, you should know the risk, you should build a good portfolio, you should monitor it often, and then of course you should keep doing your back office, your your record keeping, record maintaining, taxation, all those practices. So those things you should. So that is the framework. Now, as far as investment, can we say a few things, some good hygiene practices, right? So again, there is no simple shortcut, but just like for keeping fit, they say it's not just one thing that you do and you'll stay fit. There are multiple things. You have to keep your cholesterol low, you have to keep your activity balanced, you have to keep your sleep on time, you have to keep your eating on time, multiple things. But there are a couple of things. If you talk to any doctor, if you talk to any health fitness expert, she will tell you a couple of things, good things that you should follow. So likewise, can we talk of a few good practices in investments? That is the idea here. So some suggestions from my side. First thing is, okay, decide whether you want to invest passively or actively. What it means is that there are 2 kinds of investing methods. Active investment means you find the stocks, you build your portfolio, you find the bonds, you mix the stocks and bonds, right? Individual stocks. You figure out and build your own portfolio and monitor them regularly. That is called active portfolio, which again on another dimension, you can do it on your own or you can go to an expert. So for example, a mutual fund manager, a portfolio manager, these are experts, or even an investment advisor, they are experts. They will help you building the portfolio. A mutual fund manager, a portfolio manager basically builds a portfolio on your behalf. So whether you do it on your own, whether you go to a fund manager, it is an active investment because you are picking stocks actively. The other option is passive investment, is basically invest in the index. An index is a mix of diversified stocks in various sectors, various businesses, right? So investing in index is passive, investing in stocks is active. This is the basic thing you should remember. Then there will be variations within that, but this is the basic thing that you should remember. And you have to decide. And how do you decide? That is where you have to think what you are good at. Are you good at? So if you want to, if you want whichever way, if you want to actively invest, active investment, you have two options: either build a portfolio on your own or or get a trusted expert advisor, manager. So consult a trusted expert, just like you consult a good doctor for good health, right? So look at the past experience of the advisor, of the manager, look at the performances. More than the performances, look at the governance practices. How much information do they share you? How much transparently do they talk to you? That is important. Right. So you need to find a good advisor. So as I said, a good advisor should transparently share with you the good process of investing, help you in reaching your goal. Rather than, the objective should not be asking for tips. Tell me 5 stocks where I can invest. That's a very poor way of investing, right? You should try to find out what are some of the good investment styles, what are the investment methods. That is what an advisor should have. Outcome, of course, depends whether you follow them or not. If you do invest on your own, this is the toughest part. If you do invest on your own, you have to learn the fundamentals of investing. There is no shortcut. Investment is it deserves your full attention. Just like you can't be a part-time doctor, you should not be a part-time investor, right? Active investor, I meant. A passive investor is easy. Passive is the simplest. So active investor, you have to learn the fundamentals and you have to do the hard work. Look for relevant information that helps in making decisions, whether it is a financial data, whether reading the annual reports, tracking the company information, understanding the sector, understanding the product changes, the regulations, the international dynamics, the corporate governance practices, and so on. So imagine this, if you have 20 stocks in your portfolio, imagine doing this for 20 companies in a serious manner. And this is why I said that if you want to be an active investor by yourself, please make space and time for doing that. It is not so simple. Hone your analytical skills. There are various ways. I will not explain how to do that, but information is the first step. You get the information. Second step is how well do you analyze? How well do you interpret that information, right? So saying that import duty on certain product category has been hiked is one thing. Understanding the impact on the various sectors is not necessarily simple and straight always. So understanding that is very important. You have to develop your analytical skills. know yourself well. I mean, this, as I said earlier, you have to know yourself. Can I sleep well in the night if the stocks, if one day the markets fall by 3%, 4%, right? Be prepared for, and not just about sleeping in the night. I'm saying it is about your needs. What is it you are looking for while investing? Are you looking end to end? Next 5 years, I don't need the money. So it does not matter to me where the stocks go in the next 1 year, 2 years, as long as 5 years, it's fairly clear. Or is it that you are looking at timing the market, you are looking at investing, coming out, shifting between assets, right? Then you better be, that is even higher level of active investment. So you have to be prepared to digest the volatility in that case. So risks are commensurate with returns. There is rarely a free lunch in the markets. That is one thing I want to make absolutely clear. There has been enough empirical evidence that if some stocks, some assets give you high returns, they come with high risks also. So please remember that. And of course, if you don't understand the risks, stay away. A good example is Warren Buffett stayed away from the dot-com stocks at one time. He said he did not understand those stocks when they were doing in the year pre-2000 dot-com burst. Literally everyone was running after dot-com stocks. He stayed away. So just as an example of an accomplished investor, if you don't understand the risks, stay away. There are lots of other alternatives. One of the examples is derivatives. Be careful if you don't understand them. So these are some of the channels of investment. This is the last part of my presentation. So you can, at the simplest level, you have index funds, then you have diversified funds, then you have thematic or sectoral funds, and then finally you have high risk funds. I mean, for example, the credit risk funds, they are the high risk funds. And then, of course, you have another asset class itself, which is stocks or bonds in themselves, right? Not diversified in themselves. So you build your own portfolio. So index funds, as I said, that is the easiest way, simplest way if you are, to invest. That is passive investment. The return on risk part and the cost part, if you assess all of them, the index fund is low return on risk, return per unit of risk, but cost is also low, stress is also low. Diversified funds, mutual funds, return on risk may be moderate, but cost is also there and stress can be there. So I think this is where I will end my presentation at having gone through the investment objectives, gone through some of the key processes of investing, and finally giving some examples, some top of the mind examples on what you should keep in mind while investing. So good, thank you, and happy to now talk to you or listen to your questions and talk further.
Thank you, sir. Thank you so much for the insightful presentation. We have a very large audience viewing our presentation on Pi as well as on YouTube, and we already have a lot of questions. Sir, we have Mr. Frankie Chauhan who asks that he wants to drive slow in the investment market. But by driving slow, is there any chance that he'll get the benefits of fast driving?
No. The simple answer is no. Because if you are driving slow, then you will take more time to reach your destination. What you will gain is the benefits of a slow driver, which means you will commit fewer accidents. If there are bumps, if there are potholes, it won't be as jerky for you, right? So there are those concomitant advantages. But if you think that by driving slow, you can still make a fast driver's time to reach there, you cannot. And this is why it is important to Know which lane you are suited for. That is important. Everyone in this world does not like red color. Everyone does not like blue color. It's not good or bad. Someone wants to make good returns, but must be must be prepared to take high risk. So the belief broadly, which I want to challenge, I want to submit here, is that, as I said, there is no free lunch in the markets. If someone has been making good returns for the last few months, last few years, and assuming the style continues, be sure that she or he will also have a higher volatility, higher risk in the investments, right? That is what it will happen. So don't copy your neighbors, don't copy someone else's lane. Please stick to your lane, what you are comfortable at.
Thank you, sir. Sir, we have a question about pre-IPO investing. How effective is pre-IPO investing?
So IPO does not make a difference. It is a method of eating, whether you eat by method of investing, whether you eat by hand or you eat with a spoon, these are two ways of eating, right? It's the food that matters. So whether you invest in IPO or whether you invest in the secondary markets, that is not material. What is material is what price you are getting the stocks at and what kind of portfolio you are building. That is what is important. The related thing, important still, is that if an IPO is heavily subscribed, you will not be getting adequate shares. So you might be hoping to get 5,000 shares, you'll be ending up getting, depending on the oversubscription, 500 shares or 20 shares also, right? So it just shatters your hope, and there is nothing beyond that. Money also is not necessarily locked in these days. You have ways of financing. I'm not getting into that. So it's not, it is, so you should not, my simpler advice would be, you should not bother so much about the attractiveness of IPO. If the IPO's price is very attractive, then there will be heavy oversubscription, and anyway you will get very few shares. So you have to make judgment about, number one, what is the price relative to value of that stock? Number two, how is the broader market viewing it? If you have a different, this is one of the things about active investment also. So for being a successful active investor, you have to be different, your views have to be different from the market majority of the times, and you have to be correct also. You have to be different from the market and you have to be correct. This is why it is a joint probability, both probabilities being not necessarily high, both probabilities being moderate to low. And so this is why very few active investors are actually able to beat the index. So index is a good way of investing. Sorry, slight divergence from IPO, but I did answer IPO also. Don't bother too much about it.
Thank you, sir. So Mr. Abhishek Khandelwal asks, is it wise to invest 4 lakhs in direct stocks in current market level? What are your views on Indian stock market for the next 5 years?
So let me answer the second part first. As I said, I am a big believer in, and this has been based on my research, my own experience. Markets are fairly random in the short term. Over the next 5 years, it will, fundamentally speaking, it will depend on how the economy goes from here. So there are lots of, so to say, lots of strengthening of the economy happening in various parts of the economy that we are doing that will yield results in the coming years. So to that extent, if the economy grows well, the stocks will also do better. Having said that, Having said that, they are both expected and unexpected risks. Unexpected, last year we saw 2020 was the biggest unexpected risk, COVID, which is now becoming normalized. In fact, we are learning to live with it, so it is becoming an expected risk. Now we should not be shocked if after 1 year again some different form of COVID comes. So we should so while the economy will grow and stocks will grow well, I would say that over a longer period of time, 5 to 10 years, right? My expected return, I would not put a figure to it, but my expected return would be something similar to the previous 10 years. In fact, a little lower than the previous 10 years returns. For the simple reason that we are likely to live in a lower interest rate environment in the next 10 years. And if the risk-free rate, that is the discount rate, comes down, right? If the discount rate comes down and the risk premium does not change, which I do not see any special reason to change, the returns will come down in nominal terms over the next few years compared to the previous 10 years. Yeah.
Thank you so much, sir. So there are a few questions on something that you, as far as I know, that you have worked upon, and that is investment in gold. And is that actually a safe haven, especially when during these COVID times and when there's a lower circuit happening in the market? So we have a question which says that, is this a good time to invest in gold? And there's somebody else who is asking that, is it a good time to switch from stocks to bonds to gold? So ultimately, sir, what do you think, whether gold is a safe haven, a diversifier, or a hedge?
So two things I would like to say, Anvesha, here. One is, yeah, you are right. I have been taking some interest in gold as in studying gold. So two things I would like to say here. One is, when anyone asks me, is it the right time to invest? My answer is, I'm ignorant. I don't know. I'll be honest. I don't know whether it is gold, whether it is stocks, whether it's, I said it in so many words in one of the slides. Don't time the markets. Spend time in the market. So I don't know. Good time. Second thing I would like to say, don't invest in golds with the view of making money that it will move up from again $1,760 to $2,500 in another 6 months or 1 year. That's again a wrong way. That is fair enough. People who are comfortable with making predictions and taking bets on that, perfectly fine with them. That is why I said they know themselves. They are ready to make a bet, and the bet has two sides of the coin. You may win, you may lose, right? So that is a different part. But what I am saying is that invest in gold. Please do invest in gold for a different reason, and which is related to the safe haven. So I would not say gold is a safe haven because results are mixed. There are some positive results in certain situations across countries. Within India also, gold does act as a safe haven. What results I have based on my own study as well as other studies is that for a short term, few days or weeks, gold might be a safe haven, but it does not act as a safe haven over a longer period of time. So what it does do, it has a lower correlation compared to other asset classes with stocks. So if it has a lower correlation, right, then it gives you the benefit of diversification, which was the second part I had talked in the process. Make a diversified portfolio. So invest in gold to make a good portfolio, of diversified portfolio. That is the reason. So when you have a diversified portfolio, your risk reduces, or rather, let's put it this way, you are able to reduce more of risk than any concomitant reduction in returns. That is the benefit you should look at when you're investing in gold. Not to time gold for moving from this is the right time. For any asset, is this the right time to invest in stocks? Yes and no. Every time is the right time, provided you make a diversified portfolio and stay in it for a long time. These are the two things. Otherwise, there's no right time.
Thank you, sir. This will actually help me also with my study as far. Even I have been working a little on gold. Sir, can we take another question, sir? The last question for the evening. So we have a question on commodities market. How effective is it to invest in commodities market? Will it move as fast as the stock market over the next few months? Like we've already talked about gold, and what about the oil market, sir?
Fortunately, even compared to 10 years back, today investing in commodities is far easier. You know, of course, you can invest as a financial investor. I'm saying, investing in commodities is far easier because you can invest in commodity futures and commodity options also. So whether it is oil or gold or silver, you can do that far more easier today. So that is not so much of an issue. What is important is this is a generic rule. You can invest in anything provided you understand the fundamentals, understand that thing. So if you understand how copper moves, if you understand how oil moves, what are the risk factors? What are those factors which drive the price of oil? So if you are able to understand that and track it, then do it. But on the other hand, again, I would say that the fact is that oil and stocks, they are not fully correlated. In fact, if anything, Indian stocks, I'm talking domestic stocks, right? So see if there is a less than perfect correlation, then having some oil in the portfolio directly gives you some benefit of diversification. So that itself, I am a big champion of diversification because evidence proves that it helps generate better risk adjusted returns. So if you are an active investor, you want to invest only in oil, then do understand the risk factors. It might sound a very generic advice, but that is the only advice. If you can understand what are the factors driving oil, whether it is the Middle East factors, whether it is the US shale now coming in, whether it is India's own oil sourcing pattern is changing. Now US has become the second largest source of oil for us, beating the some of the Mid East sources. So these are the factors, various factors, they affect oil price. If you can do that, then well and good. Otherwise, invest where you understand and diversify your portfolio.
Thank you, sir. Thank you so much. There are a lot of questions coming up. I'm sure there'll be even more questions coming up as we keep the forum open, but due to time constraint, we won't be able to take any other questions at this moment. But we will be putting up a recording of this webinar on our website, the Platforms for Investors Education, PI, and all the attendees are welcome to post their questions in the Q&A section, and we'll definitely try to clear all the doubts. And thank you so much for sir for accepting our invitation at such a short notice and giving us such an insightful presentation. We've had a very large audience over Pi and YouTube, and it's been very beneficial to all of us. Thank you so much, sir. We look forward to having many more presentations from you, sir.
Thank you, Anvesha. Thank you, Dr. Krishna. Thank you, all of you.
Thank you so much, sir.
I'll take leave now.
Yes, sir, sure.